Yeah, excited to have you here today with us, Matt. Sharplink being one of the most active on-chain companies today. So today in this chat, we're going to be talking about what's happening currently with agents and the crossover with finance, where the gaps currently sit between marketing hype and actual reality, and yeah, what do we kind of need to scale this thing? So to start off, pretty much every DeFi pitch you'll see today has some sort of like working of agents in there. And the recent Cambrian report came out saying that X402 registered agents are surpassing 220,000. Just last month, $4 million was spent in terms of volume for these agents across the major networks. So like sitting in your seat, what is actually production ready? And how much of this is more kind of AI theater? And are you actually considering using any of this in your day-to-day?
So I think where investments really are different is that it's final, there's a large economic impact immediately realized if a mistake is made. But it also means you can put a considerable amount of more money into building the guardrails to allow you to do it because the ROI is immediately measurable. And so the way that we're approaching this at Sharplink is one from a thesis of, Sharplink raised around $3 billion last year to put Ethereum on our public balance sheet because we believe that part of the Ethereum story is that it will be where that global trustware finally comes to land with agentic payments, and ultimately you need somewhere where there's no recourse for everything to settle. Like the settlement layer is important, but we've heard a lot of people building incredible centralized technology to interact with agents. At the end of the day, until everyone is willing to come up with a framework for who takes responsibility for an agent's actions, very few people are going to allow things of large size to transact with an agent. Like MasterCard's building great tech. Are they going to let my agent go and purchase something for $10,000 on my credit card, knowing that if I didn't like the outcome, I might charge it back and dispute it? Who's at risk for that? And so as a result, when you look at it from a trading perspective, an investment perspective, it's a lot more binary when the outcome is known. The trade happened, the loss occurred. Sharplink itself is not trading with AI yet. I think the industry is pretty far away from doing that at institutional scale. But what we are trying to do is work with the folks who are building towards that future, investing our Ethereum in things that make it more productive. At the end of the day, our goal is to generate additional ETH, but we consider ourselves benevolent capitalists. Like, if you own a lot of Ethereum, you should do things that are good for Ethereum and also good for shareholders. And in our opinion, one of the best things you can do for Ethereum is to help the agentic ecosystem grow into something that's actually usable for the financial world that we see coming, which is RWAs, and that's a whole nother can of worms that we could talk about at another time.
Yeah. All right, I mean, on that note with risk and assessment, and I mean, even like insurance for these things, like when agents start to move real money, like it shouldn't be the same system that is deciding on a strategy to actually go and then execute that said strategy. So like, what's the number one thing that you think agentic finance should be kind of looking at in terms of assessing risk or like even blocking as a default before it can actually be used in like a professional setting?
So for context, I spent the first half of my career as a trader at Bridgewater Associates, and systemization was at the forefront of everything we did. We wanted to take markets that used to require humans to trade them and make them fully electronic. And we were able to do that in part because we separated the logic from the oversight. So that doesn't really exist in the world of agents right now. The agent is told, like, very simple example today, I'll say at this point, M dashes are ruined. Please ensure that there's no M dash or whatever you output. 3 different Q&As later, the final output includes M dashes again. It completely forgets. Now, if you're going to go and trust it with a trade and putting parameters in at the onset, 3 prompts later, you're going to have it violating its own set of initial criteria. There's no shot that anyone's willing to do it. And so there's this concept of risk controls. And in finance, you call them on-send risk controls because it's a separate system that actually goes and says, great, this thing that I'm about to send out the door, it's going to become irreversible once it leaves our company. I'm going to go and double check it against a fixed set of criteria that you've already told me mean that I am probably broken if I'm sending you it. An existing version of this for the entire world is what we would call the fat finger threshold. If you know that the largest trade you ever want to do is $1,000 in your personal account and you send something for $10,000, odds are there was a fat finger. So you should have your agent set up so that on the way out the door, if a trade ever goes out for more than $99.99, immediately turn off the entire system, something has gone wrong. That risk control layer is more important than the initial parameterization of your agent, because at the end of the day, 10 false flags are fine. That just takes you out of the market for a little bit of time. But the first time that it does something that materially deviates from your intent, it's no longer usable. And so I think that construct has to become true, not just in finance, but in the rest of the world, is simply that finance makes it so easy to quantify risk reward that I think it's often the breeding ground for a lot of these constructs, game theory optimization, to kind of take place, because people are just making good bets, and it's a lot easier to measure the ROI, so people put the money behind the development of them. I did bring a prop, which is, this is called the DGen 1. I have zero personal investment in this, Sharplink doesn't either, but it is a device designed specifically for agentic crypto trading. I put myself on the pre-order list about 8 months ago, and it finally arrived last week, perfectly in time to show it to you guys. And I went and said, okay, great. I've got this very tiny little position in an even smaller coin. Like, I want to sell 3% of this tiny little coin. Go and do it for me. And it's like, are you sure? You're going to lose like 25% if I go and do that right now. Incredible, because in that moment, it wasn't really doing for me what I asked it to do. Instead, it was acting like my guardian angel, telling me that I've got a little more insight than you do into what I'm doing. Are you sure you want to do it? Introducing speed bumps, I think, is the first thing we want agents to start doing for us. Sit there passively watching what you're doing, and if it thinks you're about to screw up royally, step in with some advice. No different than your friend watching out if you have an allergy. Are you sure you want to eat that? There might be seeds in it. Like, let's get it going there first, because ultimately you're going to start to trust agents a lot more when they save you from screwing up. And then eventually through time, as we start to understand the parameterization, you'll be able to expand. I also gave it the goal, can you double my money? And it failed at that. So we're a long way away from it coming up with investment intent, but it is pretty incredible where we are, and I think that guardian layer is an important first foray into it, risk controls being the second thing.
Yeah, that's really cool. I actually ordered one after you showed me that, so looking forward to losing my money. So in traditional finance, there's a pretty decent way to assess safe yield through credit ratings and things like Moody's, S&P, Morningstar. You know them all. Now with crypto and DeFi, there isn't necessarily a great way to assess what safe yield is. And I think sure, with humans you can assess that risk relatively so, but with agents they don't really know, and they need that definition. So what entity or group of people do you think is the right, candidates to come up and define this safe yield term so that we can push forward in terms of growing not just agentic finance, but DeFi and asset management?
So I think that it has to be trusted third parties, and that trust will be built based off of their track record. And so in the context of, let's say, a vault that you've decided you want to go and invest in, you obviously need a very easy way for your agent to go and ingest a lot of information about it. I think we're getting there with things like LLMs, .text files, and things like that. You need the equivalent of that for vaults, where there's just a industry-accepted set of things that you report on from a metrics perspective. But then there's the third-party side of things. Right now, a lot of us will rely on audits. A lot of us have our own view of the auditors, right? Not all audits are made the same. And you need the effective equivalent to become normal in the vault industry or any sort of world in which the agents are going to be making the decision, because they have to know who to trust. And you can either tell them explicitly, I value the input of the following people, or you can simply say, through time, I'm looking for you to build a trust score of this thing based off of what you can find in other people's experience. But at the end of the day, I don't think anyone's going to, at home, do the same level of diligence that someone else is able to do full time. And so we have to get to a world where you pay people for their expertise, and then you also need to get to a world in which you pay people to tell you who to trust. So I think those are the two levels you need. You need vaults to have all the information available, and you need trusted people who are evaluating the quality of it. And then you need some neutral third party that has some sort of economic upside and a material amount of economic downside to give you the advice of who to trust on those audits. And ultimately, at the end of the day, you can make it trustless while still including humans in the loop, because someone has to be there to profit from it. And agents just trying to make money to keep their servers alive, that is a cool concept, but I don't think it's where the majority of the businesses are going to be formed.
With the trusted third party, let's say not so far in the future, we're investing in agents themselves that maybe they manage a vault or maybe they just go and find other strategies to participate in. Let's say you give them $100, they double it, lose half, triple it, and they build this reputation over time. Do you think something like time not failing could be some sort of like trust factor for investing in these agentic vaults in the future? Or do we always want to rely on like the S&Ps for like their human validated trust or something?
I definitely think that time in the market is always a fantastic criteria. A lot of large allocators in traditional finance won't put money into a fund that doesn't have 6 to 12 months of track record. It doesn't matter how great you were at your prior role. It's just a criteria. They need to see that you've actually done what you say you're going to do, because that's where a lot of the execution problems come in. The other bit is from a security perspective, cryptography can't really be proven until it's seasoned. Like every day we are putting millions of dollars in a lucite vault in the middle of a room and saying, I guarantee you it's so strong that I'm just going to walk away, and when I come back, I know the money will still be there. That's how great of a vault I've built. We're doing the effective same thing on chain, and so the longer that is sitting out there as a honeypot, the longer that you can effectively say we've had a ton of people trying to get into it. They haven't, so it's less and less likely that they will in the future. So I think a combination of those two things is what a good risk agent would look at. And that's where risk premiums come in. Crypto doesn't really do that very well. Like right now, you actually get paid less than SOFR for your cash on what would be considered blue chip DeFi. There's no risk premium being built into that. I think where vaults come in, where third-party agents that you're paying for a service come in, everything else in the world, you charge people for inexperience and you compensate people for track record. I think the same construct will form in the world of agents, and hopefully it'll be a little more formulaic than going off the gut instinct that you currently have about different people you do business with.
So you mentioned regulation in there, or licenses, and I talked to a lot of people who are more on the developer side and like dreamers for like all the good, but like they are saying that they believe we can start to invest in agents almost like you're investing in an index, where like you just deploy into like an address and they go and do things. They kind of like a hedge fund basically, but what's the regulation there? Like, is it treated as a security? Or is there always going to be that like kind of asset manager who's like the front-facing person that then goes and delegates to an agent or something?
So I think this is where you get into a topic that I've heard through a lot of the panels today, which is responsibility, recourse, and liability. And I always think that there's going to be a premium associated with having recourse and having liability. A third to choke is what I think one of the panelists earlier said. And so the exact same strategy deployed out of a registered investment advisor who has been in business for 10 years, whose principals have a material amount of money at stake if this business were to go under, will get to charge you a lot more for implementing the exact same strategy, the exact same technology, the exact same logic, than someone who's offering it to you on-chain with trusted, but technically you can never prove unhackable hardware, and with no recourse back to them as an individual. And that's where I think you actually come into the insurance construct that doesn't really exist right now and will eventually grow this industry multiple order of magnitude, and someone has to be willing to bet on your action. And in traditional finance, credit default swaps tell you roughly how much credit risk is associated with a given firm. The market prices it accordingly. There's a lot of speculation on these vehicles, and that's often bad, but in the case of pricing someone's risk, the fact that a third party can take a bet on someone else's credit risk having nothing to do with the transaction is really good. It keeps the markets in fair value. The exact same construct will happen on chain. Someone else will insure a given agent, and they will get paid for doing it. And even better, someone that has an agent they believe in will offer the insurance cheaper, and they will put the money on chain, and they will say if the outcome is outside of what a human trained on the exact same thing would have done, then you're getting paid. Just like if you go to the doctor and they give you bad advice, you sue for malpractice. It's the same reason why we all send our NDAs that are pro forma to external counsel instead of ChatGPT. They never find a red line. It's the exact same contract over and over. There's no malpractice insurance. There's no throat to choke. Someone very soon will be willing to underwrite for $5 having Harvey go and look at that NDA. There will be versions of this that happen through time. investing your money will be the riskiest and the most expensive, but eventually someone will offer insurance that gets rid of that liability for you. You'll know exactly the riskiness of everything, and through time, people will be incentivized to build de-risking levers to reduce the cost of that insurance, and the market hopefully hits equilibrium. So maybe it's an over-financialized way of looking at it. I get that my hammer and nail situation is I'm a trader, and so I think everything is going to be priced to equilibrium, but that is how I think we ultimately can make this industry grow, and why I think crypto is such an important first step for it, because you need people without recourse to take that initial risk and price the risk as if they can't go and sue someone. There is no liability, so I have to price it at face value. And I think Ethereum is probably those settlement rails because you have the access to the majority of the ecosystem as a result.
All right, last question for you. So looking ahead, like X402 just brought on some pretty strategic partners or founding partners like Google, Stripe, Visa, and a few more. And so it really solidifies that like the rails are kind of here for agentic finance, and Ethereum is a pretty good candidate. But like, what's one thing that you think needs to happen over the next 6 to 12 months for that to like really be true? And what are you worried that might not be true?
I think someone needs to MVP that insurance construct. Someone that is well-funded, some VC firm, Series C, that's willing to put $100 million into a segregated pool, and they say, we are so confident our agent is able to do the following things as well as a practitioner in human form, that we are going to go and put this pool of money onto the side and guarantee it. And if you have any bad outcomes in the event of using it, we're going to indemnify you for it. We're going to pay you back. And the second someone does that, we can all stop having to know exactly the thing that we are asking our agents to do, because we'll no longer have to trust our instincts. Like, I don't trust my agents to do anything that I don't technically know how to do myself, because I couldn't catch them being wrong. It's an efficiency tool, but it's not a knowledge gatherer. It's good at showing me a lot of information, but it doesn't actually do anything for me that I'm not comfortable with myself right now, because I would never catch it. That's when I would trust it. I'll trust someone to give me advice when they've got that risk on the line. I think we need a very well-funded firm to take that risk. My hope is Robinhood, because they just released their new agentic trading system, but this is not a call to action, just using the opportunity to say it out loud.
Hopefully they're listening. All right, that's it. That's all. Thanks to everyone here, and thank you, Matthew.